All right, everyone. Thank you for tuning in. So, I think once again, we go back to interest rates. Interest rates are what are driving the market right now. Different things drive the market at different times. And when I talk about market, I'm talking specifically about equities. I mean, obviously, there's other markets that we follow over here at Stock Market Jobber, commodities, cryptos, and so forth and so on. But I'm just going to talk about equities. So, in my career, which is frankly makes me feel old, I've been doing this for like 30 years. There's really never been a time that I remember where interest rates were so important to driving our influence in the market. There hasn't been inflation since the early 80s. And in the early 80s, I was still in high school. But anyway, here's what I think is a catalyst for the market, the stock market, to go lower. Okay. Here are our interest rates. This is our 10-year yield. And as you can see, it's been in a steep decline. We've gone in the last month from about 5% to down to about 4.3%. Now, check this out. If I scroll back here a little bit, you can see that this particular level, 432, had been a resistance level. Markets go higher if there's not enough sellers, there's not enough supply, they're out of equilibrium. When we get to resistance level, all of a sudden, for whatever reason, that's where the sellers come out. They decide to sell. So this is October of last year. Same thing happened in August. Resistance. The rates go higher. Now we've gone lower. And what has happened? We've gotten back to the level that was resistance. There tends to be support at levels that had previously been resistance because of investment psychology. It's because of something that's called seller's remorse, which I'm sure you, your Aunt Mary, and every other human being in the existence of mankind has sold something and then regretted it. So people sell when the market's around 432. First, they think they did the right thing. It goes higher though. And then they say, if this gets back to 432, I'm going to buy my position back. So if there's enough remorseful sellers placing buy orders at the level that was resistance, it can convert into support. And then when it looks like the level is converting into support, some of the people that wanted to buy start to get freaked out that there are people who are willing to pay higher prices. So they go to start outbidding each other and it becomes a bidding war. And that could drive interest rates higher. And I think that's what's going to be a catalyst for the market to move lower. And I think we'll probably see this over the next few days or next week or so. Just want to show you a really good example here, what I'm just talking about. Levels that were resistance become support. It's like I'm not just making this up. It's like this is our technology sector. Resistance becomes support. Resistance becomes support. Resistance becomes support. Look at Berkshire Hathaway. The best traders let the market tell them what to do. They don't have preconceived notions. No one's smarter than the market. No one. But the good traders, they go into work with a defensive mindset and they respond to what the market's doing. They don't have preset notions. Look at this. Resistance becomes support. Resistance becomes support. Resistance becomes support. And we rally off of support because we have anxious buyers outbidding each other. So if we see that with interest rates and interest rates start to rally, I think that's a catalyst for the market to go lower. At that point, you start thinking about puts, you start thinking about inverse ETFs. You check back in with us and we will talk about it more then. Thank you, everybody, and have a good night.